Hi, this is Randy Finney with Right Side of the Chart, and this is an early session update for Thursday, February 26, 2026. It's 9:32 a.m. Eastern Time as I'm starting the video. So the markets have just opened, and I just felt like getting a video out to you guys, sharing one more thing. I gave you the charts I'm watching today. I included the major indexes that I regularly track, the S&P 500 via SPY, NASDAQ 100 via QQQ, and then the small caps. QQQ and IWM are both active trades. Initial targets on both of those have been hit on the daily time frame. So we have multiple time frames at daily. We both hit T1, waiting for those levels to go. You guys know my thoughts. I made those very clear. And now NVIDIA is out of the way. I don't sit there and watch. I hardly ever turn the TV on regarding the financial media. I will when there's a Fed decision or Powell's press conference after, or a big earnings report. I'll turn it on just to kind of see what the numbers are and listen to it. And again, you may have listened more than I did. There's not a bear out there on the video right now. They question why their P ratio isn't as high as it should be, and blah 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 blah. Either way, like I say, NVIDIA will most likely make or break this. In fact, somebody asked that question. Hold on, let me get to that. I think it was right here yesterday, so I answered it today, or I saw it today, this morning. Here we go. This one right here. I'm hesitant to short here, meaning go long the VIX, which of course, as you guys know, is essentially to go long the VIX is to short the market indirectly. A lot of PMOs turning up or crossing signal lines today. We need some catalysts for the VIX to spike off that uptrend line, but I don't know what that is. Any ideas? Oh yeah, sure. There's a couple potential market moving reports on the economic calendar tomorrow, which is Friday. But the most likely catalyst that I know of would be a post-earnings drop on NVIDIA and a rejection off the resistance levels that I just highlighted in this post today. I'm referring to the post I got out to tomorrow with the charts I'm watching. That would be the most obvious, and if it doesn't happen, then we'll probably see new highs in the market by the end of this week or next. I'll also be watching the key stocks, Mag 8 and others, in key sectors such as financials and tech, to see if any or all of the recent sell signals that were triggered are reversed. Meaning, if a trend line that I was watching or a key moving average or a key price support level is broken, and I've been walking this down step by step for weeks now, months really. If those are a key level and it gave me one of those check marks. Remember on the Mag 8, I had a series of check marks I was waiting for. Many have triggered, some haven't triggered. And if those check marks get undone by prices moving solidly back above those levels, then that means those breakouts failed. And that's hard to spin as anything but bullish. And remember, it's collective. It's not a binary thing because there wasn't one single check mark. It's been a series of check marks. We are still not at that all-in aggressive, load the boat short, whatever that is for you moment. That comes when when SPY and QQQ take out the bottom of their trading ranges. And I've also talked ad nauseum lately on the disparity between the two. If QQQ breaks the bottom of its trading range, it's going to take the 200s out that are just below. We'll go down to my second target. But at the same time, that will most likely bring the S&P 500 back to the bottom of its trading ranges and make it test the 200s. You can see, again, QQQ is within spitting distance of its 200s in the bottom of its trading ranges, where SPY is at the opposite spectrum. It's at the very top of its comparable trading range. And that brings me to this video, what I wanted to cover. Again, all this got out to you recently, been covered in videos, and you guys know I've been, other than the indexes, which of course I watch closely, I've been hyper-focused on not only the Mag 8, but also the financials, saying this is the one that needs to go. I consider myself kind of like the Dexter, that series where he was a serial killer of serial killers, that he killed serial killers. That was his thing. If you ever watch that series. And I'm like a bully, but I pick on bully. I like to pick on strength. When something's weak, I'll take it down from the top. OSG was formerly AMBAC, AMBAC Financial. We first started shorting that when it was at all-time highs, and nobody wanted to short it except me and us. And we hit all four of my targets. Perfect cover right there. Fourth and final target hit, went back up. Again, I've highlighted it in videos, and these were official trades. We milked every penny of that from nearly the highs to the lows. And then, as I said, I don't always catch tops and bottoms. I will do continuation trades. So the most recent trade on it, we shorted it. I think our entry was here on the kickback to this resistance level. I give you a max stop right here. We didn't even need it. This thing just went straight down. And my point is, it took down took it down to multi-year lows. We hit all 1, 2, 3, 4 my targets, nice profits, whatever it was, well into the double digits. But I'm not picking on this one anymore. It's weak. A bully picks on weak ones. I like to pick on the strong ones, and not just for the sake of them being strong. Please don't get me wrong. But what I'm picking on now and have been are financials. Again, that's been one of the top performing sectors. It is to the largest extent why the S&P has been recently tapping on new all-time highs. Yet the Nasdaq 100 has already is well off those highs, and it was this. So just to recap, if you're new to the site, we had a breakout right here above 54.50 right there to all-time highs. A breakout which I predicted would fail, did fail. Then we had a sell signal right there, break of the trend line, that minor trend line, back test, rejection. That was my first check mark when after that initial breakdown and back test, and we fell back below the 54.47 all-time high. Then we took out the trend line right there, the secondary uptrend line right here, pretty much the last one, and back tested that after bouncing off that 53-ish support. Then I got a big fat check mark when we took out the 200-day moving averages. We hit the 51. I do want to comment on this. That was a key level to me. We took it out, but we jumped back above it. However, that's why I'm doing these videos. I put a bigger weighting on the 200-day moving averages, and that's what I'm going to show you here. So, like I said, this week and really maybe into next week, because there's only 2 trading days left this week, has really the potential to alter the trajectory, the technicals, and change my outlook. As of now, my outlook hasn't changed. Couple days again, I told you that everything that happened yesterday and even the last couple days to me is just noise heading into Nvidia. Again, you cannot argue that's the biggest stock in the world, the biggest publicly traded company. It's the largest component of the Nasdaq 100, largest of S&P 500. So alone the mathematical weighting, but the psychological importance there is no close second to it in the AI bubble and the importance of even the economy. It's like they talked about the first time in history where GDP has actually been significantly moved and boosted and kept positive, not from, it's usually consumer spending. This time around, it's been that massive capital expenditure on the AI circle jerk bubble going on. Anyway, so let's talk financials. So this is where I think, and I like this. I like when I'm watching something the rest of the world isn't watching. Everybody's talking about, all they're talking about on CNBC is NVIDIA AI. Oh yeah, the AI bubble's intact. That CapEx spending just keeps up. And so again, I'm looking at something that that I don't think the market's looking at is underestimating the importance of. So what we're going to do here, or what I'm going to show you, is I got a big check mark when we took out the 200s. And as I recently highlighted, we back tested them once, rejected, and now we're back testing again, but we're still below them. So until and unless the financials solidly recovers the 200 days, that's bearish. Now let me show you some statistics, okay? So you might think, Randy, you put too much weighting into that. Well, let's turn on some numbers here. Let's take away all these lines. Let's go find a clean board, or we can just turn this off. And let's put up this indicator. It's a custom indicator I've created. It shows me the percent that, or maybe this one might be in part of this charting program. There's other programs that, let me see. No, it's a custom one. I created that out of the price oscillator, and what it shows is the percent that whatever I cue in here, in this case XLF, the financial sector, is trading above or below its 200-day moving averages. All right, and I can go back. I'm rolling back. This is a daily chart. This is as far as it'll let the indicator populate. Price will go back here to about early 2020. And then the way this charting program works, they need that time to populate whatever's on the screen. So here you can see right here is where the indicator starts. Okay, so let's just start here. What I'm going to do, I'm going to take a measuring tool. I'm going to show you, well, let me just, first I'll show you the crosses. This is where we've crossed here, here, that's all red. There was a big fat juicy bear market, very profitable to trade in the financials. Hell of a bear market rally, but another big drop. So I'm just going to go over the periods. What I'm going to do is just show you the price performance, or what happened to the financials each and every time we've coming off. Remember, with the PPO the other day, I talked about these hills. You know, on the PPO, they're a little more clean, the momentum indicators, but this is, again, a strong bull market. Anything should be trading above its 200 days, and it almost always is, right? That's bullish. You know, you can you buy pullbacks, you recognize a bull trend, you buy pullbacks to support or breakouts above resistance, right? Or you can short corrections if you're a nimble active trader. So here we go. We flipped right here, right down here. You can see we flipped. And I'm just going to take, what I'll do is just give you, I'm going to grab right before that happened, the highs. I'm just going to measure down, show you what the correction was in the financials. That was 28% roughly from high to low. And again, remember that in almost every instance on our long trades, I'm bullish before the trend indicators slip. I'm long and bullish based off things such as trend line breakouts, pullbacks, drops to support, bullish falling wedge breakouts, and likewise when I short, usually I'm shorting trend lines like I'll be on the 60-minute chart and have that uptrend line right there and a little wedge, and that'll get us in. And then so we're in usually before these trend indicators flip. But what I want to show you here, and I just did, and I'll go over all of them, is associate the drop. So 28%. Then we had a nice fat rally right there, right? It was 22%. You would not have wanted to ridden that out short. So you can see the indicators. We're back above the 200s, but we crossed right here. So again, I'm just going to measure from the high to low to just kind of show you the corrections associated with a flip in the 200s. In other words, when it loses the 200s. And when you're after a bear market, by the way, guys, there's what I call a reset period. So I'm going to ignore this little whipsaw here because we're coming off a hell of a bear market. We had every other reason, and we were long there. You can see I had an official trade here. We did short it. We got in early on the financials. T1 was hit there, made a marginal new still divergent high, hit my third and final target there. And then we had a nice fat divergent low. This is where I get bullish and long on these divergent lows. But going back to that, so, a little whipsaw like that, I don't want to put a lot of stock into it after you've had a multi-month, nearly a year-long bear market, right? Okay. But then you got above it quite a bit. You back tested it. That's when the 200s were recovered here, right here. Back tested, a slight undercut, and then clearly above. But we lost them there again, and I'm just going to measure out, and I'll move a little faster here. 18%. Then we had a nice multi-month rally, followed by, there was a cross right here, was the first crossover, and then additional crosses right there. And again, I'm just showing you the performance associated with the periods when XLF was below the 200s, without any exception. We're going through here, 13%. Right here, I'm going to put the crosshairs, this will cross right there. Even though we peaked here, I'll just measure from this high because that's when we had a bounce, a test. They bought the 200s. But then right there, that drop to there was about 18%. From the highs, if you count that, 21%. Remember, you're always going to be at a high before you take out the 200s. So I'm just showing you again these corrections associated when the financials lose their 200s. Run about 22%, right? And that's in an ongoing bull market. Just God forbid, let's not even go there right now, but just we'll entertain it. God forbid the secular bull market does end. The first time around, the first drop is going to be a whole lot more than 22%. Those are really just bull market corrections, if you will, those 22% or so drops I'm showing you. And you can see here, as I mentioned and highlighted at the time, that was one of my check marks. We crossed and we're back testing right now. So maybe it's going to be one of these. But you know what? So far, if I measure from the high to low, the drop has only been 10%. So that would be atypical, a lot lower than the roughly 20% usually get. Again, that time from the high to low, you had a full, 20% drop there. This was only half of that so far. Anything's possible. And look, guys, if the financials get solidly back above here, not a single day, it's incremental. Again, it's not binary, but yes, when you're above them, okay, you can consider that bullish. But the further you get away from them, and the more clear it becomes that that was a whipsaw, just like that. And again, call it a whipsaw, but again, it was a big drop. Even if you waited to short the drop below the 200, you still made 10 better than 10%. You can see right there from when the 200s are lost. It actually happened on that gap down there, about 11%. Okay, let me do this one more time. We're going to go a little longer. We're going to go up to my weekly chart here. Again, the technical posture says everything to me. That's a big divergent high here. Let me park my 200-day, 40-week moving average. I can scroll back a lot farther. I can go back to the previous. This is the last real bear market. That was the last end of the bull market run. I didn't have this marked up. I'm just going to show you. It was a big divergent high. This is the 2007 highs. For those of you that were around back then, that's the financial crisis. The financial sector dropped. XLF was around. I'm gonna have to go over here I can measure this way by turning off my lines so I don't move them. That just shows me that I grabbed at the high. I go down to the low. My pop-up box on the left tells me 84.5% drop in the financials, right? And again, it was telegraphed in advance. It wasn't random from a technical perspective, at least not through the lens that I see the market. We had nice, clear, negative divergence. We had a wedge, beautiful uptrend line. There was a sell signal, and that's what would have got you in short. And again, so what I want to show you here, and then I'm going to show you one more thing, and we'll wrap this video up. Divergent high, divergent high, divergent high, divergent high, divergent high, and divergent high. So going back decades now, we have 1, 2, 3, 4, 5, 6, 7. All right, I already told you that was 6. I'm sorry. Did I just say 7? 6 of them. That was 84%. Obviously, that was a financial crisis. The banks were all going to zero, but the government came in and backstopped them, bailed them out. 27% drop off that one. Off this one here, the initial drop was 27 or 28. I'm rounding. This drop here was 43%. And this divergent high here was 31%. And this one so far has been 10, right? We did have a little, this was actually their first divergent high right here. And we shorted them back there. I believe we did. That was back in, yeah, we did. We were definitely short them. So that was DH1. But this is just an extension of the same divergences. That's what you often get. So that first drop there was 21%, right? Maybe a bit higher if I can grab that candle right at the top. And about 21%. So again, we have now the same divergence is even larger. There is no set formula, but typically the bigger and longer the divergence is, the bigger the drop, right? This was DH1 before COVID. Nice drop there. The divergence got even bigger and the drop was much bigger. So this is what I'm trying to impress upon you guys here is this is what I don't think is being talked about. And this is my analysis, right or wrong. That's what I do day in, day out. I give you no guarantees other than I'm going to be wrong. I'll be wrong a lot. So you do you, I'll do me. But like I told you, I'm been taking advantage. I told you the VIX yesterday pulled back. Everybody's foaming in the mouth bullish because, of course, NVIDIA beat. Who in God's green earth didn't think they're going to beat? If last quarter they had more business than they can even handle, they're going to beat. And they're going to, and Jensen Huang's going to come out and do he's something. Boy, he tries to jawbone his stock up like I've never seen. But anyways, all right. Now we're on a weekly chart, and I've replicated the same indicator here using a 40-week simple moving average, right? I can do this with an exponential. Did I? Yeah, yeah, oh yeah. I use it simple. Okay, I can toggle it and do exponential as well, but we'll just leave it on the simple for now. They're almost identical. You can see when I change it. Okay, so a 40-week, when you're on a weekly time frame, a 40-week moving average is comparable to the 200-day moving average that I just started with on the daily chart, because there are 5 days in a week. 5 times 40 equals 200. So that's where you get that. So it's pretty much the same moving average. And that's it. So again, what I'm going to do, and then we'll wrap this video up. And, here's the financial crisis. I'm just going to box in the period where we went below the 200s. And again, these don't look like a lot. This is log scaling. I just went through it on the daily chart, and I showed you that the average corrections, most of them around 20%, if not more. Some of these are higher here. And as always, guys, I encourage you to do this on your own chart. I never try to twist or skew the facts to make it look like what I'm trying to come across. Look, if you want me to do a bullish video on the market, I could talk for 3 hours on all the reasons why the market might go up for the next year or so. It's not what I think is going to happen. I think the evidence supports the opposite. But I'm just showing you, and again, look at these. We've been in a very strong secular bull market since the financial crisis in the financial sector, but there's been huge drops. And remember, stocks tend to fall a lot faster than they rise. They usually wipe out months or years of gains in a matter of just weeks or months during corrections. And so that's it. I think this evidence speaks for itself here. These again are what I covered on the daily chart, and you can see, and that was, again, doesn't look like much. It was 21%, right here. It's not much, but that's that. So therefore, unless, and guys, and if the unless part, we get solidly back above the 200s, and this was a whipsaw, I won't be shocked or stunned just because we only had a 10% drop, and that's, again, atypical. It's a lot less, especially considering the divergences. But if this is the beginning, this loss of the 200s, and we're going to look at something like this, or God forbid this, right here, that was the COVID drop, 45%, or this, 85. I don't think we're going to get 85, but I do think that again, I think all eyes are on AI and not a lot of people watching financials. And I see still plenty of potential landmines in the sector. I told you I would stop the video here. I just had a price alert on Interactive Brokers. I had one the other day too. I already gave that to you as a short trade. Let me just click on it and take a look at it real quick. Trying to park my indicator back there. Interactive Brokers just alerted me. Oh yeah. All right, you guys we already hit T1 here. This was a trade shorted back, I guess, on that breakdown. We hit T1, marginal new high. And I think I highlighted it the other day as still very a lot of meat left on the bone there. And then the last thing, because again, some of us are glass half full guys and gals, and that's good. 99% of the time, or 90, whatever it is, that's what you want to be, because the stock market goes up. But when valuations and sentiment and all these other extremes are out there, I start looking for those cockroaches that, long before Jamie Dimon uttered the, you see one or two cockroaches, there's more. I was zeroing in on business development companies, BDC, saying that this would be show trouble. Broken, gave you 4 targets. We hit all 4, turned around. We ran it the other way. 1, 2, gave you 3 targets, closed it out there. I decided to put the quick profits, and good thing we did. We sidestepped that give back. Then when we got up to my third and final original target, then I said it would be an objective re-entry, short entry. And we've gone down, and we do have positive divergence, just like we did here when we took it. Except this time around, as you notice, I haven't given it to you as a long trade. It's my kind of chart. Divergent low at major support. That's a major reaction low. That was a 2022 low. However, this is where I think one of the likely, what I call it, gray swans. When I started talking about it back here, it was a black swan. I'm not trying to say there wasn't anybody warning or saying, hey, there might be problems in the private credit sector. I just didn't read about it. And I even did extensive Google searches on it. This is where everyone started talking about it when they started sliding down here. And that's probably when Jamie Dimon's cockroach thing came out there. But what I want to point out is you got to understand the ripple effects in the credit markets if there's more shoes and there is. You look at what Blue Owl had to do, tightening up or shut down or restricting redemptions. That tends to have a domino effect, and everyone else in the other BDCs are going to want their money out because they don't want to. And I'm looking at some of these guys just blowing up here. This is from KKR. That's a huge private equity firm, KKR. This is their private credit publicly traded company, FSK. Look at it, down another 14%. It had divergence. It keep having divergence. This is what I often say, that on a bull market, I say the road to new highs in a bull market is paved with negative divergences. Those are negative divergences that either don't play out at all or do play out for just a quick correction or a short pullback. Likewise, the road to a bear market when you're going down, again, it's just a silly saying I made up, is paved with positive or bullish divergences. Some of those, like this last time, we took it. That's when we bounced after covering our short on BDC. BIZD, I'm sorry. We gamed the bounce and then got out. But this is what happens. You tend to burn through these divergences. And especially as the reality starts to set in. So look, you can't completely write this sector off yet. But I do think there's a good chance that it could implode. And when it implodes, it'll carry over to the banks. I've read about this. There are especially a lot of regional banks and other banks that have the same loans out that these private credit companies do. That's loans to these data centers. This whole AI hype, this overbuild with data centers, and a lot of those are the loans that are now underwater. They've been marked to fantasy. You guys know that private credit, just like its close cousin private equity, they have the luxury that publicly traded companies don't of marking their assets to fantasy. Even publicly traded companies can really play around with the books and use creative accounting, but they're held to a higher standard and with the quarterly reports. Whereas private credit and equity, they get to make up the value of their stuff. And all of a sudden, that's fine if it's really the loans are worth 80, 60 cents on the dollar, and they're telling you they're worth $1 on the dollar. But when they have to start being liquidated, and that's what's going on here, that then resets things, right? And so problems in the private credit markets, which are the business development companies, is even though it's a relatively small portion of the total credit markets and financial markets, it can have ripple effects. And so let's see who else is down today. Well, I just wanted to highlight FSK and also highlight the fact that BIZD is dancing on a critical. That's, it takes that out. We're going down to multi-year lows not seen since around the post COVID era there. So, all right, that's it. And so, yeah, just wanted to point that out. So watch the financials, watch the 200-day moving average, and if it gets rejected, especially if it takes out the recent lows on XLF, I think you'll see the momentum start to build to the downside in this sector, and then days, weeks, or months later, you'll start reading about the blowups in that sector, and then the infinite, wisdom of the folks they march out on CNBC and Bloomberg, and they'll be telling you when XLF is down here and here and here. Oh, well, yeah, we had this credit event here with this company, and then that triggered, problems with some of the regional banks. I still, by the way, love the regionals as a short. KRE broke down recently, back testing, a lot of meat on that bone. The broker dealers, still one of my favorite sectors. I just showed you Interactive Brokers. Robinhood came very close, but not yet to my initial target right here, long-term target of 67.27. And when you look at the weekly chart, turn on all the lines, pretty much hammered off that support so far. That's big support. And if it loses that support, and I do believe it will. I believe this is one of the brokers that will be probably lose 80-90% of the value before the next bear market's over. Again, whether that comes this year or not, just due to the kind of the business model and the clientele that they attract. I think they're one of the biggest beneficiaries of the credit, the margin, the FINRA margin credit bubble, debt bubble that we have right now. That once that pops, like I said, that's almost impossible to put that genie back in the bottle. Okay, I'm going to stop here. This has been Randy Finney with Right Side of the Chart. Have a great day.